Welcome to Code and Concrete, the leading podcast for prop tech, conversations about the built environment, and other exciting innovations. If you learn something new, please consider following and leaving a positive review. Enjoy. Hi folks, welcome back. Joining me today, I have Florian M. Spiegl. Florian is the founder and CEO of Evident, a fully licensed, full-stack digital market for private asset transactions. He works at the intersection of private markets, asset structuring, and digital market infrastructure, helping asset managers distribute private assets more efficiently while expanding access for professional and private wealth investors. Florian focuses on practical deployment of asset tokenization, digitally enabled distribution, and liquidity solutions, bridging traditional finance and emerging digital capital markets with institutional standards and regulatory clarity. Lots of big words in there. Definitely some industry jargon that we'll have to unpack in a moment here. But first things first, thank you so much for coming on the show.
Thanks for having me, Matthew. And yes, indeed, a lot of concepts, I would say, worth unpacking, and looking forward to that conversation.
And a little fun fact for our audience, Florian, you're calling in from Hong Kong, is that right?
Yes, I'm based in Hong Kong. We operate from Hong Kong as our headquarters and serving clients globally from here.
That's super exciting. I love international conversations, or as we might call it within the industry jargon, cross-jurisdictional conversations. There's so much that we can unpack, lots of insights, and it's super reaffirming that tokenization and the troubles of private markets are global issues. It's not just the US, it's not just Hong Kong. All over the world, we're trying to solve these problems, and it's conversations like this that hopefully can move the industry forward a little bit. But before we dive into anything, I'd like to unpack who you are as a founder and how you got here.
Well, my background, maybe to start at the very beginning, I grew up in the Austrian mountains, had a very adventurous childhood. And my first profession, you could speak, is to be a forester. So I come from a very different background. Because in Austria, we have this wonderful system where you can actually learn a trade and then decide if you want to go on and study at university or just enter the field without studying. So I decided to continue studying, and I was one of the few from my school who actually went into economics. And the bridge for me was, a forest is a big economic machine. It's about growth. It's about sustainability. How much can you take out without ruining the fundamentals of it? And that's what brought me to economics. And then my path was via strategy consulting into finance. So my background is into traditional wealth management, asset management. And then I moved to Hong Kong now almost 9 years ago, started a fintech firm, realizing that technology, digitalization is going to completely change this industry. So that was, I would say, the first real fintech wave, 2015, 16, 17. So this company was building trading systems initially for equity brokers. And then we were part of the first, I would say, institutional crypto wave. So building systems for institutions in the crypto space. We exited that company in, we could say 2022. And today, Evident is a continuation of that. So using blockchain as a new system of record and as the foundation of new market infrastructure. And we're very focused on a specific sector, and that's private investments. So anything from private equity, private credit, infrastructure, real estate, all the way to collectibles and specialty assets. We look at just the broader alternative space. And the reason is that the innovation, the pace of innovation has been the slowest in this part of finance. And there is a huge interest of private wealth investors to participate in the space so the two sides connect perfectly. That's where we really see opportunity building market infrastructure for this area. Yeah, and finally, we're based in Hong Kong. We're fully licensed in Hong Kong. We're the first to get a license for this here. Our clients are really everywhere. Particular growth areas are in Asia and the Middle East. And I can only echo what you said earlier. We're, I would say, politically in a world that is complicated. It's hard to predict, but it's really reassuring to see that there are these areas like the whole blockchain industry, where it's all about collaboration. And to me, also capital. Capital always finds a way to flow into places where it can be efficiently deployed. And we are part of that. So taking out the friction in these markets and in that way connecting markets more efficiently.
Yes, it's a beautiful thing. Blockchain is quite diplomatic. There's events in every country, Western, Eastern, Northern, Southern, and we're all trying to accomplish very similar goals. I'm curious about your entry into crypto. What did you find interesting about it at that time? And then as you made a transition into institutional blockchain, what were some of the use cases you really wanted to capitalize on?
Yeah, in a way, it's a sad story for me. So my my first touch point with crypto was very early because I read the Bitcoin white paper pretty much when it came out as a PhD student in economics and political science in Vienna. So it was sent to me by a colleague who said, this is kind of interesting because I'm rooted in the Austrian School of Economics, which is a much bigger thing now since Bitcoin. It used to be very niche. So as in the Austrian school, we have a very specific way of looking at the role of the state, which is reduced. We have a specific way of looking at the role of money. And so the Bitcoin white paper was very interesting as a thought exercise, an academic exercise. And the story is sad because I didn't take any kind of economic action based on that. But that was my first interaction with the philosophy of this entire space, but then also with the realization you need technology to make that a reality. And so it's been with me ever since, and touch points have been there ever since. But really entering the space was with the company I mentioned earlier, where we were either working with the crypto industry or building blockchain systems actively. And if I look at it today, we take a very specific position as Evident as a company, and for me as a founder, that blockchain is this new system of record that allows essentially to have one global database, one global source of truth in finance. And for anyone who worked in finance, in banking, you look at core banking systems, or in asset and wealth management with very specialized siloed systems, that's a big deal. You have one place where everyone looks at the same data in real time and it's immutable. That's huge. And so if we work with clients in Hong Kong, in Dubai, in Frankfurt, we all look at the same data at the same time. And this is, I think, is really fundamentally allows us to build new market structure on top. And so for me, that is one of the killer use cases of blockchain. It's digital market infrastructure and moving away from the manual processes of the past and the systems and ways of storing records that we still use in these markets today. But the direction of travel is very clear, that we move onto digital rails also in the asset and wealth management industry, and particularly in assets that today are mostly transacted manually on paper, PDFs, emails, WhatsApp messages, WeChat messages, calls. That's the typical way of transacting in private equity today, doing a secondary. And that's going to go away completely. So we see a rewiring of the entire industry. That's the next 10 years. So these change cycles take time, but it is happening. And I think Evident, our company, is one proof point that this is getting very real. And there's no doubt anymore that this is where things are headed.
Absolutely. And this is where I think we can appropriately use the word infrastructure, because what exists for private markets right now is nothing. There are no systems that are really connecting the issuers, the underlying assets, the data around them to marketplaces and exchanges. There are small instances, and there are definitely companies that are spearheading the initiative, Evident being one, but we have to build out the full global connectivity in a successful and compliant, regulatory compliant manner, and certainly no air leaks. I think that's part of the reason why adoption has taken a while, because if there are small errors in the system and something goes wrong critically, blockchain is one of those technologies where finality is truly final. There is no reversibility. So taking our time and making sure that we understand the technology and implementing it correctly is very important. But finally, that infrastructure will exist. And the amount of capital, as you said, that will unlock is incredible. So much is currently trapped. And there's also other asset classes or regions that are underserved in terms of capital. So it's going to be very interesting to see how that capital hegemony changes over the next few years.
100%. One thing I want to highlight that I don't want to get lost in the conversation, you said something really interesting and I think important and correct, which is there is actually no infrastructure. So whenever I hear people saying, oh, we need to replace infrastructure, we need to rip it out and build new one, there is none. We're building new infrastructure on the green field. Totally agree. Nothing that deserves the label of an infrastructure exists, particularly in private markets. And this is one of the key reasons why we specifically focus on that area, because it allows you to go back to what you can call first principles. First principles in our world is regulation and the law. And we spend a lot of time, also me personally, in the first 6 months plus, just reading regulation and the law and understanding what is required regulatorily, what does compliance really mean, and then build new systems from the ground up. So forget the old way of doing things, because you can't call it infrastructure, but building real infrastructure from the ground up based on how this industry functions. And of course, regulation and the frameworks that exist and that are well proven are the starting point. They have to be. And then, but you could take that and say, how can we be compliant in a new way, in a digital way? And this is, I think, where a lot of the interaction also with regulators comes in, discussing together what the rules really are, what they mean, and then how can you comply to them in a digital way? And that's what it means to build new infrastructure from the ground up, because there is none to be really replaced. I think that's a very good point.
So of the use cases that are most beneficial to private markets, it seems that data symmetry is first and foremost, because when you're using a decentralized ledger, it's actually a unified ledger because we're all looking at the same information. What are some of the downstream effects that data symmetry in private markets and even other markets could enable? First thing that comes to mind for me is composability and price discovery. What are you guys looking at?
Yeah, so I think the effects are quite profound. If you look at how things work in a traditional world, and we can start very high level and say, in the end, the effect is easier access and discoverability of transactions. It's the ability to attract and create liquidity. And the third part, primarily for us relevant because we are serving private wealth clients for the most part, is really efficiency, and a better term actually is convenience and more convenient access. It's not like our clients don't have access to these assets for the most part, but it's very complicated. It's tedious, cumbersome, takes a lot of time, and it's expensive. So you have large minimum tickets. You need to invest serious time and resources into getting into these deals, securing them, structuring them, transacting them, and then clearing and settlement. All of that is all manual. And then once you're invested, I mean, these assets are called illiquid for a reason. There is no liquidity in them, and that goes back to market structure. And then finally, it's all about, am I able to do this from my phone? So that's one thing that we also learned, particularly last year, 2025, as we were scaling really strongly. I had the wrong notion that if you take this kind of investment decision, let's say you're a family office, you looking at a big screen, and you take your time, you go to the data room. And we saw in the data and from conversation with our clients, the majority of these transactions are then effected and executed on mobile, where people do that wherever they are, whenever they take that decision. And that's not just a question of the next generation. I think as the next generation of investors come online and they are inheriting a lot of that money, that effect will be even more pronounced because they grew up with that way of transacting all on mobile. But even the current generation of investors shifted everything on mobile. So that's the third part, convenience, access. So those are, I would say, the highlight elements, but we can dissect that. So if you think about just access, what tokenization does is it allows us to standardize assets and standardize how we can present them. If you think about it, in our world, in private markets, transactions happen in very regional or very local circles. It is who I know, who I have on my Rolodex or on my phone, that drives a lot of deal activity. And discoverability is a real problem. The other way of looking at this is there is a much, much higher interest to transact than ability to discover deals. That's one thing we saw. This is a huge growth market just from what we see in terms of demand coming to us. So once you digitalize, you can actually lift this entire industry on a digital plane. And what happens is quite similar to what happened with e-commerce to commerce, where all of a sudden you have global discoverability. And this is a reality. We see our clients in Dubai discovering deals that are here, in Europe and elsewhere, clients in Korea seeing the same things that everybody else sees. And then you see that interest to transact to become a reality simply by discoverability. So to me, access is not about let's go to $1, let's go all the way to all the way to retail. We still work with professional investors, institutions, but just for them to have better deal transparency, discoverability changes everything. And so quickly on liquidity, you could similarly argue what tokenization does not do is you can't say a liquidity mechanism equals liquidity. A liquidity mechanism creates optionality. It does not magically create buyers. But what it does do, it reduces settlement risk greatly. It greatly increases settlement speed, and it lowers overall friction in the system. And that automatically leads to more transactions, which means more liquidity. And so organic liquidity will take time. We are bootstrapping some of that liquidity, and in the end, the market structure looks different, and the market structure always beats the raw technology. So liquidity is primarily a market structure problem, not a technology problem, but tokenization as a technology reshapes market structure. And this is where we see more transactions and therefore liquidity happening. So I think these three pillars, they are very real. So we see this every day. And maybe the final point on that is all of this is only possible because of the digital nature of the underlying assets. And that is only possible because of the specific technology blockchain. We looked very hard at the beginning of Evident into, can we not just use a fast database for this, a centralized database? Because our clients really don't care. They just want great deals. They want these benefits, access, liquidity, convenience. If we do this with a database, they wouldn't mind at all. But it turns out there are specific qualities of this underlying technology that make all of this possible. And this is why I look at when people ask me, well, why do you even tokenize? As you can tell, I can speak about this for hours. There are very clear, precise reasons that are tied to processes and market structure that require us actually to tokenize. Not that our clients mind, but we mind as a business.
Well, let's unpack some of that, because as you were speaking, I was coming up with a devil's advocate question, which is how much of this is actually a product of digitization and not tokenization? Because here in the US, we can securitize, trade, distribute easily without a blockchain as a common ledger for the parties involved in that transaction. However, there are efficiencies to gain from blockchain. Now, in other parts of the world, the way that the securities regulation is being introduced or redesigned is on the basis of a blockchain on the basis of blockchain technology, such that if you tokenize or if you securitize through a token, that you could fractionalize that further, or that it's treated and transacted differently than traditional securities. I believe that MiCA in the EU has some design components like that, which would vary from the US. And I can't speak to the securities regulation in Hong Kong in particular. But taking it back to the question of the particular and nuanced issues in traditional markets and market structure that tokenization alone can solve, what are those?
Let's first unpack the first point. So I think if you look at the broader trends, it's worth pointing out one key insight that we had early on at Evident that was also clear pretty early on in Hong Kong, and Hong Kong today benefits from that regulatory clarity, which is saying we have digital assets as a broader group, and then you have two bigger subcategories. The first subcategory in Hong Kong actually called virtual assets, which is essentially crypto. The second subcategory are called tokenized or digital securities, with the emphasis on securities. So the position in Hong Kong and other jurisdictions, including in my view with MiCAR, is the correct position to say these are still securities. The emphasis here is on securities, and digital is just a additional definition. So we have securities laws. They are well proven, they are very well thought through, they are adjudicated, etc. Very reliable regulation and laws. So we can just build on top of that and add additional rules if you actually deal in digital securities where arguably the most important record keeping is on blockchain. So you have some additional elements, but fundamentally, you just have a different kind of database that works in different ways, has different requirements. But because you have a different database, how you do a portion of that business, let's take secondaries and secondary trading, works differently. So that's, I think, let's start there. The way we look at this is, and also as Evident, we operate within this part of the world, which is digital securities. And this is where it's really just about market infrastructure. We're not changing fundamentally the assets, not the nature of the assets themselves, but the nature of how we interact with these assets. Now, if you think about the specific role of blockchain, there are many examples, but one example, or maybe one of the most important ones that you already touched on earlier is maybe I can illustrate by saying today it is not as important. Today we could still do this on a blockchain, but this is not where the market is going, because the market is heading to a more globally integrated market. And this is where a standardized data infrastructure is crucial. And I just recently posted on that. This is not a given. This will require hard work not to have this wonderful standardized data layer with bridges between different standards, but in the end, it's a standardized data layer. And then we start building silos on top again and lose everything. So it will be work. So we have jurisdictional topics. We have intercompany operational topics where how do you create interoperability operationally? So these are things that as Evident we work on very hard with our partners, again, across jurisdictions every single time. That's heavy lifting to say, okay, the nature of this tokenized security in Hong Kong is this, and the nature of this tokenized security within the UAE is different. So how do we create that bridge? It requires work, but the opportunity is that we create truly global markets and that we aggregate this very dispersed liquidity pools I mentioned earlier, that we connect these very local liquidity pools together. And this is what it means to really alter market structure. So it's fundamentally driven by the composability that you mentioned earlier of blockchain. And then we need to do the work on top of that to make sure that we create open markets. This is where the opportunity is. When everybody's talking about liquidity, this is where liquidity sits. Because if I have a common standard with our partners, then it can really flow across jurisdictions. And again, I cannot stress this enough. This is a reality. We do have investors everywhere, and capital just flows between jurisdictions. As long as our partners are properly licensed, we are properly licensed, that's happening already. So it's more about the long-term potential rather than today, anyone could argue, your local business, you could just do in a conventional setup. But this is not what the market will look like. The market will be much more connected. That's at least my, I would say, very clear core thesis as a founder, where you have to accept you could be wrong, but every indication we've seen, particularly in 25, where growth has been very strong, to me points in that direction. And we want to be part of that story and actively shape markets in that direction.
The one thing I can really speak to in your answer is the data standards and really standardization overall. Right now, private markets are apples to oranges, especially when you look at real estate or infrastructure, because the way that you capture data about these assets, the way and the frequency at which they're appraised and valued, and the reporting that follows, it's sporadic. And even in more regulated markets, it's still really not sufficient. And that's why they're private markets and not public markets, because it's insufficient. And so as we start to standardize how we value these underlying assets, and then above that, standardizing data value, reporting, and the technical layer as well, and regulation as well, because you need different jurisdictions to agree to cooperate fundamentally, because if a security becomes a non-security as it crosses the border, then you have additional issues. So all throughout the stack, there needs to be consistency and there needs to be expectations. And then you see that global opportunity, global distribution, and a renowned trust and confidence in these assets. And that, I imagine, unlocks a lot of liquidity as well, because when you can place bids on assets without incurring an unreasonable amount of risk, then you will place said bid because you want to have access to that asset. And right now, the underwriting due diligence process for these assets and then executing the investment is so opaque that it's simply not reliable, not for large sums of money. And at which point it gets so drawn out that it takes absolutely months. And as you were saying, people want efficiency, they want convenience. That means being able to have that same trust of institutional due diligence, which may take months, and compressing that to days, minutes from their phone. New institutional grade deal appears on Evident, and I can invest in that at a moment's notice because I have no quarrels with the investment. I have no concerns, issues, worries, or anxiety about what that underlying asset is or the technology above it.
Yeah, I totally agree. And to the point that one of our clients, the family office, said that to them, Evident is turning into a type of trading terminal for private assets. So deals are coming in and they just pass on deals until they see something that they like. And then they take it and it's immediately available. And you click. If you onboard it, literally you click, and you're invested. This is very different from the reality of how this works today, as anyone can attest to who operates in private markets today. So yes, absolutely, that is happening. And what's really critical, and I cannot stress this enough, is we're discussing what changes and what gets better and the opportunities. But we should also focus on what does not change, what fundamentally does not change, that it's in the end about the asset quality and the robustness of how this asset is structured and the transparency that comes with it. You can token, and we all have seen all these projects and announcements. So, and I always say, we don't go out and say we tokenize. Even in a lot of meetings, our counterparty in a meeting says, listen, you could use blockchain for that. You could tokenize it. So, yeah, we tokenize it. We don't just come in the room and scream tokenization, because really nobody cares in the end. It's about the asset quality. And the beauty of that is, if I may say also on a personal note, is the asset quality is still about relationships between humans. So we build all this technology, but the technology is about efficiency. And we use a lot of AI, for example, in our processes, because once the asset is digital, you can build digital processes on top because you have the data quality for it and the reliability. And then you can release agents on certain parts. And actually, we continuously add AI capabilities at different parts of our end-to-end value chain. Why do we do that? I realized that over my Christmas break. Fundamentally, we do that so we have more time to deal with the messy other humans. And that is a beautiful thing, because in the end, this is still about trust. This is still about human relations. and human communication, which is supposed to be messy, supposed to be inefficient, supposed to be a waste of time. But once the decision is taken, okay, I love this asset, I'm in. Everything else after that, so the execution, clearing, settlement, can be and needs to be hyper efficient, and we can leave that to the machines because that's boring work. That's not for humans. And for decades, basically still today, because we're still at the very beginning of this, we're taking out a lot of the joy in investing by having to spend a lot of time on the tedious processes. We shouldn't. So if anything, and again, it's more a philosophical note, we will come back more to what investing really means. Putting capital into things you believe in, things you find exciting for whatever reason it is, and getting meaning back from investing. It's not just about creating more money from capital. It's also about getting meaning out of it and supporting what you believe in. And that feels like a very soft point to make, but that drives a lot of volume, particularly in private markets. And I think technology will take this role of freeing up more of our time between humans. And that really matters. And this is why we're so intensely focused on getting these processes right so that we can work our way to this state where we can spend more time with our clients, with our partners. And frankly, that's also a more enjoyable way of working.
Well said. What type of assets do you have on Evident right now? Because I believe you list your platform as alternatives. So what does that all include? And then where are you seeing, this is a threefold question, actually. So what assets are on Evident? What assets do you think are benefiting the most from blockchain? And then what assets have investors been most interested in?
Yeah. So I can combine my answer across these questions. So we focus on the segment of private investments, alternatives, private investments, private markets. So broadly speaking, private equity, private credit, infrastructure, real estate, and what we call specialty assets, including art and collectibles. So we also cover what I would see as new, exciting, almost frontier assets. I'll get to that in a minute. So let's start with the big ones. For us, the biggest growth segment has been private equity secondaries. And the main reason is that demand is off the charts. Demand in private wealth for these type of deals is really high. And we regularly see multiple times oversubscription of assets that we have on the platform. So when we talk about secondaries, we focus on individual exposure, direct exposure secondaries. So that can be a private investment into an AI company in the US, in Asia. That can be a pre-IPO investment into a company that is going public here soon. So we see particular demand, for example, in certain pockets, like Chinese technology companies that are in their vertical world-class. So everything in robotics, in drone technology, in the EV value chain, in batteries, in nuclear, etc., is, you could argue, are really strong companies that have very attractive valuation points. So again, it's driven by the asset that really also makes us focus on certain asset types, and private equity secondaries and pre-IPO deals have very strong structural tailwinds that we feel, and so we go where the growth is and where the market demand is. And this is why this is one very important part of assets on our platform. If you think about credit, the killer feature is different. The killer feature really is about automation. Because the credit, you have predictable cash flows, you have frequent servicing of the asset, you have clear covenants, etc. So on the lowest layer, as we all know, in terms of volume in tokenized asset, money market funds, for example, are really important. They are less important to us. We look at tokenized money market funds more as a cash infrastructure, not an investment product, because our clients use it to park money, not to hold it there. So when they get a distribution, they swap it into a money market fund product, park it, and then when they see an opportunity, take that cash in real time and reinvest it. So to be able to enable this use case, we need to be able, for example, to book daily distributions. If you take our money market fund, that's a State Street money market fund, They're daily distributions. So we completely automate all of that. So every day, investors get distributions into their account, into their wallet, and can use that immediately. And so once you build out the ability to automate in that frequency and with that precision, you can use that for any kind of credit product, because in the end, it's about distributing those cash flows and servicing the asset. That gives you an edge around the asset experience that clients have. So credit products are almost the risk-off version or the counterparty to the risk-on private equity investments as we see it on the platform, and we can create benefits there. If you think about infrastructure, just to touch on that as well, it's similar. So you usually have infrastructure that in a way is asset-backed finance. So you have an income-producing asset that is backed by the physical underlying infrastructure. And particularly if it's also related to an impact component. So if you take energy infrastructure, for example, transportation, modern transportation infrastructure, investors are very interested in that as well. So for example, we have assets in the energy shipping infrastructure where you participate in the underlying ship. It's backed by that equity and you get distributions from that ship. Quite similar in a way to real estate because you're renting out the ship. And that allows financing of fleet renewal. So a new ship in a fleet is much, much cleaner than old ships. So in a way, it's a contribution to transition finance. And this is where private wealth investors are also, I think, quite interested. Finally, if you think about collectibles from fine art to collectible cards even, which we consider specialty assets, and the new frontier of these type of assets where you see real volume and you see serious investors now breaking into the space, but they don't quite know how. This is, again, the edge is about access and convenience. I can get exposure to a Pikachu card, click, click, click. I don't have to source it. I don't have to put it in a vault. I don't have to insure it. I don't have to put it in some kind of museum to create value in it. I just participate. So we see the same mechanisms really around convenient diversification across these asset classes as driving business. And the last point to make here is this is really why we decided to be cross assets, because in the end, we want for people to build truly diversified investment portfolios. If you don't have private market assets in your portfolio, you are not truly diversified. Private assets are the largest asset class in the world, right? Because, yeah, we have public markets which are easily accessible, but all the assets that are private in totality are much larger, actually. And so, in a way, real diversification requires you to participate in them. And that's the ultimate goal and service we want to provide.
I have two clarifying questions. First, when investors are paid out in crypto, what currency is that?
We don't pay out in crypto except for stablecoin on-ramp and off-ramp. So in a way, we allow buying power of funding your account on our platform in stablecoins. Here's where we work with regulated partners, so we don't do it ourselves. And then investors can choose. They can withdraw that back into stablecoin. They can withdraw that in fiat currency. So this actually touches on a big part I haven't spoken about, which is very important for us, which is we essentially run fund administration, accounting, reporting, transfer agency in our own business because we had to insource that, given that there's not really any alternative in the traditional world. And so if it's about on and off ramp of currency, digital or fiat, we provide that as part of the service on the platform.
And what stablecoin is that? Or stable
USDC
coins?
for the most
USDC.
part.
So what is the status of the e-Hong Kong dollar? I've only heard of it. I have not seen too much news about it, though.
Yeah, so that's its own world, which we don't really operate in. Again, we look at this as infrastructure. So the status is that following it's, I think the strategy in Hong Kong is to create regulatory clarity, have really strict rules, so in a way create a very high fence, but then really support the operators that are able to comply. I think it will play out similarly in Hong Kong, that the stablecoin regime is taking shape, is going live, and then we will see probably not too many players being able to comply with these rules because they're very strict. They're all about investor protection. But those few will have a real business that they can build on. Because if you create hurdles that are very low, I think on certain infrastructure aspects, it makes it very hard for companies to really build business models that scale, because there's just too much competition on something that may not offer enough differentiation. So I anticipate that, like everywhere else, stablecoins will be a huge use case, and in a way you can put it into the tokenized context, because in the end it's tokenized money.
Mm-hmm.
And we look at this purely as an additional piece of market infrastructure and efficiency, because now I don't have to take in your money to fund your account. You can just settle directly wallet to wallet in an atomic settlement. We are not in the business of holding client money. Right now we do for a lot of our traditional clients, because that's just how the industry works. And we saw this shift into stablecoins even from institutional clients. So this is not really a crypto story. This is a story of just higher velocity and efficiency of money. And that will clearly play out, because if I can shave off another half day or day even on the settlement side, because I don't have to deal with the slowest piece right now, which is the banking infrastructure, institutions and professional investors would go for it. And I see this definitely continuing. So any serious jurisdiction has to have a strategy and a regulatory framework on stablecoins, no doubt. So Hong Kong is one of them, and I think that view is very clearly arrived. There are also other important initiatives where I feel like jurisdictions are still figuring out where are we on CBDC versus stablecoin on the other end versus tokenized deposits somewhere in the middle. Do we disintermediate banks in the end, or do we give them a role? So I think a lot of the answers to these questions are not there yet. Everyone is trying to experiment and test. And then what we see here, particularly in tokenized deposits, we're also part of a project called Project Ensemble TX here in Hong Kong by the Hong Kong Central Bank, the HKMA, as the only pure play tokenization and private assets platform, is really to show real transactions. So we're moving away from the announcements, the white papers, and the reports to everybody needs to show real transactions. And I think that's very encouraging to see. So in summary, 26 will show some of these infrastructure elements from stablecoins to tokenized deposits to really support real market transactions. And that is critical for that shift to a digital market infrastructure to happen.
We'll talk about 26 in a second. I have two more brief questions out of my own curiosity. First, a lot of us here in the US saw the headlines before Christmas about Beijing having influence over stablecoins. Is that still a precedent, and what's the impact? And then my second unrelated question is, you mentioned transition finance, which is referring to the green transition, I believe. What are some of the benefits of investing in green investments as opposed to non-green?
Yeah, two very different questions. So let me take the political one first. And I think this is also hopefully good for international viewers to get some color on that. So how Hong Kong is positioned in the Greater China context now is that Hong Kong has the regulatory framework, and I would even say has the mandate to push innovation in digital market infrastructure. That is very clear if you're here on the ground. Regulators want to see that infrastructure upgrade to happen in a controlled way. And this is where the unique opportunity is. China mainland is different. And when you mention certain regulatory clarifications, personally, I thought this was actually very positive, because the regulators in China very clearly said, including on so-called RWA, which is a term I don't really use, please everybody be aware that this market is becoming a little bit frothy or even bubbly. And there's a lot of players who are not licensed. And reminder, these are securities, And if you're not licensed to deal in securities, you're not allowed to deal in these assets. So there was a very strong message that I felt was clarifying and also was designed to dampen down the excitement, because you saw that happening. And then, as in any, quoting Carlota Perez in her book, Technological Revolutions and Financial Capital, it is totally normal that you have speculative capital, that you have speculative projects. And at the end of that cycle, you have all the way to fraud, a fallout of a new technology really going into distribution. So I think regulators try to avoid that fallout by being very clear. There's zero tolerance for that. But what was the effect of that? We felt it immediately, that we had more client requests coming in to tokenize assets, because everyone understood, okay, in Hong Kong, you have licensed counterparties to do that. And you can do it in a completely licensed, controlled way, as opposed to, let's say, the experiments in an unlicensed context. So if anything, I felt it was pushing that energy in the right direction, which is a proper setup like we discussed. And in the end, focusing on great assets and investor protection, which matters. Nobody wants to lose money. Nobody wants to invest into a scam. Of course not. And regulations, part of that, or maybe the most important role, is investor protection. And so in the context of Greater China, Hong Kong clearly has that role. And that is a unique opportunity for Hong Kong as a modern financial center to still connect these capital flows globally, but also to continue to be this two-way street on capital into and out of mainland China. And we just recently launched, to illustrate that, a cross-border project where the tokenization happens in Hong Kong. And then we use traditional structures onshore in China mainland, and we're able to create a bridge where investors can invest into supply chain finance in the high-tech industry in China, which is its own really fascinating, interesting world, but it is invested in a digital format here in Hong Kong. And to me, that's one example of how the future will look like, at least how I would predict it to be. And so the recent developments and communication from the regulators, I felt, were only clarifying and reconfirming that general direction. On the second topic, more briefly, transition finance, the way I look at it, and we are very open, because the beauty of markets, back to my Austrian school roots, is the beauty of markets is I don't have to be right or correct or anything. The market will take care of that. So we leave it to investors to take a decision if they care about impact and what impact means for them, because it's a very individual thing. I am not saying ESG and green and this and that. We just show the data and keep things transparent, and then investors decide if they care about it. One area that I personally find very interesting is to say, look, we have huge industries in the world, and shipping, for example, is one of them. Back to that example, that you cannot just flip a switch and say, oh, it's now running on batteries. That's 20, 30 years out, realistically. So, okay, what do you do in the meanwhile? You need to clean up that industry 1 basis point at a time, literally 0.01% at a time. But the industry is huge. So a 10 basis point or even 1% cleaner industry of that scale means that has the same impact like building a lot of new solar. When people say, oh, we need to do this and that on a green field, we need to stop flying, stop shipping, that's not realistic. I'm a pragmatist. I like saying, no, we still need to ship goods around. We all still want to fly. But how do we make these industries cleaner? That's the definition of transition finance. You're transitioning to a cleaner setup of the same industry without killing that industry and without having unrealistic goals, because you have to be tethered to reality. I can dream about, no emissions, but that's not the reality. So if you want real impact, you will care about transition finance. One way is to say, okay, how do we make the shipping industry, as an example, cleaner? As I said earlier, well, have modern ships that literally have 10x lower emissions than traditional ships. They may have other challenges, but just fleet renewal is one way of transitioning the industry gradually, not from today to tomorrow, but gradually into a cleaner state. That change requires capital. And that's what transition finance is, putting capital into enabling that change. That ship, it is a really interesting income-producing asset. There's a really I think, attractive cash yield. So you can just take it for the investment, but the additional effect is, oh, by the way, in addition, I help transition that industry to a cleaner setup. Maybe it matters to you,
Right.
maybe it doesn't. To a lot of our clients, it really matters. So
Hmm.
this is how I would look at it. But again, we leave clients the choice because they may not care about it, or this may not be the main decision point. In the end, it's all about protecting wealth, growing wealth. But one thing I will say, what we do see in private wealth is that the importance of an asset having meaning, and I'm using the word meaning, not impact or anything else, is quite high. It's not at the top. You still care about making money, preserving wealth, making wealth. But especially for younger investors that are getting access to inherited money, trillions, as we know, over the next decades, the meaning of the investment they make, and that could include the positive impact on climate and other things on society, is sometimes immediately after that. So I know there was some backpedaling on a lot of these topics, and I dare say, particularly in the US, we have seen it less so in Asia. So in Hong Kong, when you talk to family offices, particularly next generation, that's still very high up on the list. And I think it's its very own opportunity in this space.
Certainly. Awesome. Well, let's look at 2026. What can we expect from Evident, and how can people either stay up to date with all of your progress or even get involved?
Yeah, I mean, starting with the second part of the question is literally reaching out and connecting. So mostly I'm on LinkedIn and also on other channels. But for us, back to the human topic from earlier, this is still about strong long-term relationships. Nothing changes. We go to digital. In the end, it's about building long-term partnerships. So we're very interested in both sides. So asset supply from asset managers, asset owners, GPs. That's my primary focus. And then, of course, also the distribution side. So private wealth partners that can be family offices, multifamily offices, digital platforms, increasingly also just plug into us to offer these type of assets to their clients and extend their product shelf. So anything in these contexts we are very interested in. And we always explore together and see what we can build exciting together. But looking at 26, one thing that hopefully summarizes 26 when we look back is really going from noise to substance. So from announcements to transactions, more assets, more transactions, less of, are we going to tokenize this? So I also feel like tokenization, is already the case for Evident, will move into the background also for the industry, because it's not in a standalone setup, not solving anything. It's about the asset quality and the benefits you can bring. And another thing, though, we will see is, when I mean less noise, I also mean more things happen under the surface that I think people are aware of. I just look at our own example that we don't announce most transactions because we are in an industry of discretion. People value privacy, people value discretion. So we do announce things, but maybe 10% or 5% of what we actually do. And so my suspicion is that 26 will see growing volumes, but not everything will be immediately visible. The second point, I would say liquidity becomes the main topic in question. When in 25, we were all talking about who's tokenizing, what are we tokenizing. 26 will be about where are the buyers and where is the liquidity, right? Because a lot of things would move on chain, but can you really place it? Also tell people, first of all, don't tell me about your plans. Tell me when you did it. And then don't tell me about what you tokenize, because I can tokenize literally $10 billion tomorrow. That's not hard. Come back when you distributed it. Tell me about what you placed in the market. So that will be a 26 theme. I can already see that. And we try to be ahead of the curve with our own liquidity mechanisms, with our own liquidity facilities to really serve that need. And that's always been our focus, not just the issuance side, distribution and liquidity. Maybe as a last point, the market is increasingly ready. So asset managers, distributors, they're very interested in this. And I don't have to do a whole lot of explaining anymore around what does tokenization mean, what are digital securities. Traditional, TradFi, so to speak, players are now very well informed about this. and very knowledgeable about it. And that makes me confident that we will see broader adoption in the traditional finance field, in DeFi as well, which we probably don't have time to cover today, but we will see this convergence happening to continue in 26. So that for me is another theme: stronger institutional adoption that doesn't really care about tokenization, but the benefits and the assets. And then also a stronger drive in DeFi to diversify from the very simple products we have today, from repos, which of course are very bank specific, to money market funds, which are to us are not really a product, but infrastructure, to more interesting complex products. That's another expectation I have for 26, including in the DeFi space.
Well, you're right. There's a lot that we could continue to talk about, but this is probably a good place to put a bow on the conversation. I've really enjoyed talking to you. We're very heavily aligned on all of these topics, and it's just very exciting to see how much the industry has grown and the seriousness of the conversations that we can have now. As you said, it's no longer just about headlines or announcements that 10 billion has been tokenized. We need to discuss, how is this being distributed? How are we redesigning market structure? What are the real benefits that this technology is going to have for a firm, an investor, especially in terms of their P&L, because that's what they care about. That's why they would go an extra step to leverage this technology. Well, I will have links to all of your information in the show notes. I highly encourage people, especially in Hong Kong and East Asia, to reach out and look at Evident. I've said it before. Now, I don't promote platforms, but I've said it before that it's clear you guys are the trailblazer, really. You're leading the way in terms of RWA. I'm going to use that term, tokenization in East Asia. So really wishing
Thank
all
you.
the best for you. Hopefully I'll see you at Hong Kong FinTech Week 2026, and maybe we can do another podcast then.
Absolutely. Thanks a lot, Matthew. Great conversation.
Thank you. Take care then.
Take care.